Welcome to the Steadmont Advisors 2025 Economic and Market Outlook. Really appreciate anyone that is joining us today. Really excited. We've done a couple of seminars on this already today. Look forward to doing this in a webinar format. Do realize you can ask questions in the webinar chat, and we will either answer them here if we can get to them during it, or we may catch you offline afterwards. But you can type into the Zoom webinar chat if you have any questions, and we'll try to get you live here. So I'll get started here. I always like to name our outlooks after a song that I think is pertinent. And I think this song that we're going to do today, "The Times They Are A-Changin'," is about as good as it gets. Now, to be fair, I think it's probably going to be good in any environment because the times are always changing, and that's a pretty evergreen thing. But I'm literally going to walk through the lyrics real quick and talk a little bit about what we're seeing in them because it's a really great and well-written song. It is a song written in 1964 by Bob Dylan. We had people in both of our live seminars actually get that on the fly. That was pretty good. And a really well-written song here. So when we jump in, I'm going to start reading these things, and it just blows me away. I mean, it probably didn't sound that good. He wasn't known for his voice, but he really knew how to write some lyrics, and obviously the tunes were great. This one goes, "Come gather round, people, wherever you roam, and admit that the waters around you have grown, and accept it that soon you'll be drenched to the bone. If your time to you is worth saving, you better start swimming, or you'll sink like a stone, for the times they are a-changin'." Outside of feeling like I'm reading Dr. Seuss a little bit, been doing that with my kids recently. Just that paragraph alone, just that line alone, is so poignant. There's themes there of a call to action, right? You better do something. But the first thing to do is to be sort of humble and aware of your surroundings, to be aware of what's going on. I think that's so important for us as humans, for us as investors. If we're not doing the work to at least be humble enough to accept where we are, it's tough to know how to move forward. And then you obviously got to do something about it. So I'm going to keep going here. "Come, writers and critics who prophesize with your pen, and keep your eyes wide. The chance won't come again. And don't speak too soon, for the wheel's still in spin, and there's no telling who that it's naming. For the loser now will be later to win, for the times they are a-changin'." This is great. Gosh, this was written 60 years ago. They had writers and critics back then too. They might not have been as loud or anonymous as we have on the social media platform these days. Um, but it's amazing. They back then they were just writing a bunch of stuff, prophesizing. But keep your eyes wide open because the truth might actually hit you at some point, guys. I can't tell you how much bad information there is out there. I'm on Twitter way too much. Sorry, X, whatever you want to call it. I'm going to continue calling it Twitter. I'm on it way too much, and you literally get people that don't have a clue what they're talking about, acting like they know what they're talking about, saying opposite things, and we all know that can't be true. For the wheel's still in spin, and there's no telling who that it's naming. Gosh, 20 years ago, who would have thought television star Donald Trump would be our two-time president? Not one of you would have thought that. There's no telling who that it's naming. And then the losers now will be later to win. Um, no political party is in power for longer than, 8 to 12 years, really. I mean, when's the last time we had a political party in power for that long? So the losers will be winners and the winners will be losers. And I think being respectable in both facets is a really good quality in our country. I hope we will continue to do that because you never know who your next partner or boss or trying to accomplish a deal with is going to be. But the times they are a-changing. All right, talk about Washington. "Come, senators, congressmen, please heed the call. Don't stand in the doorway, don't block up the hall, for the he that gets hurt will be he who has stalled. The battle outside raging will soon shake your windows and rattle your walls, for the times they are a-changin'." Um, won't stay on this too much. I mean, real obvious. I mean, we're talking about people in authority. We're talking about shaking things up, making things happen. Don't block progress. Let's move forward. Let's realize where we are and move forward. Same thing with mothers and fathers. Come, mothers and fathers throughout the land, and don't criticize what you can't understand. Your sons and your daughters are beyond your command. Your old road is rapidly aging. Please get out of the new one if you can't lend your hand, for the times they are a changing. Again, evergreen. This 60 years ago. It doesn't stop. Parents think they know what's best. Their children think they know what's best. The grandchildren think they know what's best. We all need to all be humble. I think understand our place, understand our surroundings, and try to do what's best with it. The line it is drawn, the curse it is cast. The slow one now will later be fast, as the present now will later be past. The order is rapidly fading, and the first one now will later be last, for the times they are a changing. The reason I really printed all these lyrics, all of these themes are really important to us in life, really important in the world of markets and finance. You see it all the time. You see the order rapidly fading. You see the new becoming the old. You see the ones that are first now become last. There's literally a financial term that said past results are not indicative of future returns, usually because it's the opposite. If things have been good, they usually go bad. If things have been bad, they usually go good. For the times they are a changing. And so it's amazing how poignant, I think, especially in the context of where we are sociologically, politically. We're having a lot of change happening at once. AI, artificial intelligence, crypto. There's a lot that is changing, but there's also a lot that stays the same. The names might change, but the name of the play stays the same. So let's jump into it. 2024 recap. Really important to understand where we came from. 2024 was, again, really good year. If we look at all of these different indexes, a lot of them are equities or stocks. These are obviously commodities, gold, silver, crude oil, and then these are all bond indices. You can see that last year to date, that's last year, 2024, the top performers being the S&P 500, the NASDAQ, and gold. Can't tell you how strange that is. It does not happen very often that gold, equally performs or outperforms stock in a big up year, but it happened. So, a lot of those things signal some of the animal spirits that are in the market. I think a lot of people continue to be concerned about inflation. I think a lot of people are worried about geopolitical happenings and currency risk. So I think there's a reason that gold has been on such a tear and at all-time highs. Kind of an old song here, S&P 500 and NASDAQ being the best returning assets. Obviously, in a bull market, in a risk-on environment, they're going to continue to be. Why do I talk about the S&P 500 and the NASDAQ in the same sentence? Guys, right now, they're basically the same thing. We'll look at the next chart, and you'll see a visual of that, but really important to understand that. Look at all the other equity indices. If you really got a bead on where global stocks were last year, you can see here, equally weighted, Dow Jones, mid cap, small cap, micro cap, international, emerging markets in the 11 to 12, 13% range. Okay. So if historically stock returns have averaged 9 to 10%, a better than average year. Okay. And then great year for S&P and NASDAQ. Commodities had a good year, at least these three, crude oil, silver, and gold. And then bonds struggled as interest rates rose. We'll see a chart of that later, how that really went down. The short end came down and the long end went up. Ultimately, therefore, longer term returns were poor. We all know that as interest rates go up, the prices of the bonds go down to compensate. That is a feature, not a bug. And we'll talk a little bit about that as well. So an average of all these different indexes, about 10%. If you take roughly a 50-50 allocation, 10 equity indexes, 2 commodity, and 8 fixed, you get about 11% return. That's what you should expect from a well-diversified portfolio. A little bit more if you had more of the NASDAQ, and a little bit more if you had more of the gold. You can mix that how you want, but that's about where you come out. So the next chart is going to be a visual representation of the different asset classes for 2024. I always think it's important to look at the visual. It shows you that it's not a smooth ride, right? We got bumps in the road. Multiple times, the S&P 500 and all the other indices went up, corrected, went up, corrected. That's so normal. Again, feature, not a bug. Without that volatility, you're not going to have returns. Look at these low volatility assets, less returns, right? And that's going to happen over a long period of time. Something else that's interesting here, if you look mid-year, so look at the chart just to the right, Most of all the indices of all the asset classes went dead sideways or down for the second half of the year. Even the S&P 500 and the NASDAQ, it looks like it went up, and it did go up a little bit, but not a lot, right? The second half of the year was not nearly as productive as the first half, and December was a poor month. Had a lot of comments from clients recently about how bad December was in spite of a good year. I know the last statement's all that matters, and a down month's worse than a good month, but a really good year for returns last year. Looking forward to 2025. We'll talk about expectations. We never talk in expectations of 1 year, but I will talk in expectations of 10-year and beyond and what we're looking to do there. Like I mentioned on the last one, look at the S&P 500 and the NASDAQ. The blue and the green right here. Hard to tell the difference between the two, isn't it? We're going to talk a little bit about why that is, but the real answer, the short answer, is that it owns a lot of the same things in a lot of the same percentages. And so you're not getting too much diversification between the two, and they are at all-time concentrations, and we'll talk about the risk of that as well. So I'll jump back to this chart right here. Obviously, everybody wants the things that are up a lot, right? But the times are changing, and the first shall be last, and the last shall be first. This time period, this time period, this time period, this time period, the best, the best, the best. Look at the S&P 500 25 years ago. What could have possibly happened 25 years ago that the return has only been 5.5%? Oh, that's right. That was the dot-com bubble. So if we pay the wrong prices for assets, we have the chance of having suboptimal returns, meaning you expect 10% returns and you get 5 or 6. It's possible. I'm looking at it right now. In fact, if you look at that 25-year time period, okay, you're seeing a period where equally weighted S&P 500 has outperformed both the cap weighted and outperformed the NASDAQ. Obviously, it had a poor run here, and we're going to look at that specifically, but that's what can happen. The first can be last, the last can be first. And obviously bonds pulling up the rear here. It's just a lower volatility asset class, about 4% return over that time period. Remember, interest rates roughly went down that entire time period. So you got lower and lower rates of return over each investment cycle. But this is where diversification really helped, right? 2000 through 2010. You have the NASDAQ. In the live version, I asked people, which one are the two that you wanted to own? You got to remember that NASDAQ went 10-year period being down total return of 50%, not annualized, but total. And, S&P 500 down 9% during that time period. Emerging markets were the winner. I mean, they were rock stars back then. I mean, I can remember the conversations around, you got to own China, you got to own emerging markets. And, they had a relative currency tailwind then as well. And that's some of those advantages of diversification that you can get. Here's the equally weighted S&P 500, 85%. Versus -9 for an entire decade. That's diversification, right? You get the benefits. If you rebalance through here, I bet you got an even better return as you bought things that were low and sold things that were high. There's ways around here. So it's just more confirmation and just showing in graphical format why you may at some point want to own things other than just the S&P 500 and the NASDAQ. Not that we do in our portfolios, but just a lesson on those types of things. So where are we today? Really important to talk about. I really want to inform people where we are from an economic perspective. There's a lot of people shouting at the TV saying things are good, things are bad. What's the truth? If I don't do anything else, I want to bring the truth to you. I want to put the information in front of you, and you can draw the conclusions. I'm going to give you my conclusions. They're not very interesting because I'm just stating the facts. For instance, this chart. This is the GDP growth, nominal GDP growth year over year. And I made it real simple, equals pretty healthy, 5% growth. That's pretty darn good. In fact, it's higher than the post-financial crisis decade we had. We pretty much averaged about 4.5% during that time period, and we're in the 5% range. Now, normally you hear a much lower number when it's quoted on the TV, but that's going to be adjusted for inflation. So in today's numbers, if we're at 5 and inflation's at 3, you're going to hear real, that's the way they call it, real GDP growth at about 2%, which is right in line with where we've been for a long, long time. So you can see here that we're really coming off the COVID, very technical term here, COVID weirdness. And we're trying to see where we're going to end up, where sort of go forward normality is. Really hard to paint the picture of of a recession happening unless one of two things happen. In fact, possibly both things. The thing that would really push us into a recession at 5% growth is if we obviously had slowed growth plus higher inflation, right? If we were at 5% inflation right now, we'd be at 0% real GDP growth. So if we came down 1%, say because of slowing growth, because of things like tariffs or deportations or something, and we had a rise in of inflation by 1%, so down 1% in growth, up 1% in inflation, we're basically even, and that's technically going to be close to a recession there. So we got to watch those things. It's really important that we keep our eye on it, but 5% growth is pretty good. Now, why do we have 5% growth? I asked everybody in our live versions, what was GDP made up of? And unfortunately, not many people, actually, we had one. We had a great client that chimed in and said, you know what? I remember what you said. It's spending, right? Consumer spending. That's exactly right. 70% of our economy is made up of consumer spending. Another 15% or so is from government spending. So a lot of it's just how much money we're spending. And I would say that outside of having a money printer, consumers are in a better financial standpoint than our government. But obviously, we would all love if that turns around. So GDP growth pretty good. If we jump into jobs, obviously, if we're talking about consumers, we got to talk about jobs. In the long run, if we want consumer spending to go up, we need both jobs and income to go up. So we're looking at jobs here. You got two lines. The orange one is the household survey jobs. The blue one is payroll survey jobs. Why are there two? Well, there's different metrics for measuring these things. And anytime the jobs report comes out, there's both of these. The payrolls number obviously includes reports from companies about their payroll. That's pretty obvious how they get that information. The household survey does include all sources. So you're going to get things that aren't included in the payrolls, like self-employed folks and agricultural jobs. So that number is always going to be higher. And usually it's pretty in line with growth. But look what's happening recently. Look at the orange line being relatively sideways while the blue line's still growing. Interesting phenomenon there, and we'll continue to watch it, but it's definitely important to know that the larger number, the more complete number, has been pretty sideways for the better part of 2 years. And you can see it in this growth chart. So this is the same number, but just in percentage growth. And we're straddling the 0% line. Historically, 0% or lower, we're getting into recessionary environments. Obviously, if there's less people working, there's less income, less spending, therefore less economic growth. It's that easy. So let's look at income. This is, again, we're talking about people that are employed versus all. The orange line here is going to be all income in America. And you can see that during COVID, when the blue line here, which is employed jobs, went down because people were either laid off or stopped working, the government jumped in and pumped up all income, right? You got checks in the mail, things like that. We're just now getting back to a more normal dynamic, and we're at 5 or 6% growth in income. Obviously, if we're going 5 or 6% in income, that's 5 or 6% more every year money that people can spend, 5 or 6% more economic growth potential, right? These things tend to line up over time. In fact, if you look historically, it tends to line up mostly over time with corporate revenue, S&P 500 revenue growth. So, I mean, it makes sense that the spending in America lines up with the revenue in American companies. So therefore, their income picture. Then we look lastly at personal consumption. All of these things line up in the 5-ish% range. So if we're making 5% more, we're spending it all because Americans are amazing at spending money. In fact, we're about to jump right into personal finances. Are we saving a lot of money? Well, we're saving about 4%. You say, well, we're not spending it all. Remember, this is an aggregate. This is every American. There's a lot of people that are saving a lot. There's a lot of people that are not saving at all. In fact, going into debt. The average of all that out comes out to 4% savings, which is a relatively low number to history, but also relatively in line with the last 20 years. This is interesting, though. If you look at interest payments to disposable personal income, higher, not hard to understand why. Mortgage rates are higher, auto loan rates are higher, credit card debt rates are higher. All the debt is higher. We're more in debt, therefore higher rates. It's going to take a longer time. In fact, if rates don't go down, meaning mortgage rates and auto loans, as people cycle into new ones, they take on the new debt, they roll off the old debt. So if I had a mortgage at 3%, I want that bigger home. I pay 7%. All of a sudden, I'm at a much higher rate of interest payments than I was before. So we're watching this as well. This is disturbing as well. Share of active credit card accounts making the minimum payment at a high versus the last 13 years. People don't do that unless they're in more debt than they can pay off, or if they just have basic financial literacy, which is also the case across America. So we're watching this as well. If there's active accounts making payments with all-time high rates, then you can imagine how much pain a lot of people are feeling. This one feels the most pain, though. In America, I think a lot of people think that one of their rights, it's definitely not a right. It's a freedom that we have. But I think people think that if I can't afford a home, I'm not making it. Well, look what's happened to the cost to own a home. This chart is showing income required to keep home payments affordable. The red bars are median household income, and you've seen us grow that from roughly, what's this number? About 53,000 in 2012 to almost 85,000 a day. That's pretty great growth. I mean, you had a lot of inflation in there, but if you look at the cost or the household income needed to own the median price in America home, it's grown more than that. Right now, it takes $115,000 to keep your monthly payments below 30% of your income at today's median rates. So people can't afford the homes that are out there right now. Now, the other side of this, you might say, well, gosh, why are people doing that? Why are people getting into homes they can't afford? Well, some people feel like they need to. Some people are willing to stretch. But the other thing is, there's a lot less home buying activity going on and refinancing activity. People are kind of staying still. So maybe they can afford those, and maybe we will see a correction in prices. You're seeing some correction in prices in places like Austin and Florida, where people moved to during COVID. They're now moving out, so there's a lot of activity. So we're realizing maybe the real prices of things, and you're seeing prices kind of stagnate across the nation from a home price standpoint. In your particular location, maybe they're still going up, but talk to realtors. Most places, you're at least having not the same kind of urgency, not the same kind of deals being done. And I think you can see that across the data. So, I think if we look at the economy, hard to paint a bad picture today. I think we could be heading into some tough spots, especially if the economy slows, especially if inflation goes up. We're not in the strongest position we've ever been, and we're through a lot of the excess savings that we had during the pandemic. The next thing that's really important I want to talk to, not going to get political, but really important we talk about the new administration, because there's several points that I need to make to y'all that are probably on your mind about certain policies that are coming out. Not going to talk about the politics of it, the sociology about it. But if we think about the economics of it, some of the things that are really going on here that might have some long-term implications are obviously immigration, trade/tariffs. Everybody's talking about tariffs. Everybody on Twitter is all of a sudden a tariff expert, and obviously tax policy. And what are the implications of each of these? I'll go ahead and tell you the punchline, and then I'll talk a little bit more in depth on each of them. But each of these tend to be inflationary. Okay, if we're sending low wage folks out, then we're going to have to find higher wage folks or a different way to do it on the back end of that. Trade tariffs have always been and probably will be now inflationary. We're literally putting a tax on goods that will then be passed on to the consumers. And then lower taxes also tend to have inflationary effect as people have more money in their pocket. So they all tend to be inflationary. Immigration and trade tend to be a drag on growth. Lowering taxes tend to have a addition to growth, and we'll look at that from Goldman Sachs's point of view. But if we look here at this Apollo graph, actually this is not Apollo, this CBO projections for population growth, and we'll talk about why that is important. This is total population growth, the total stack here. The gray lines here are births minus deaths, so net births. How many people were born in America, natural births, minus how many people died. So that's the increase in the kind of legacy population. The blue lines here are net immigration for total population growth. Look what happened during COVID. We had a lot of deaths and people were having less babies. We had a very low net birth rate. We had a lot of immigration. The next couple of years, we had a lot more. But you can see the projections. By 2035 or so, the CBO at least projects that we will have negative net birth rate. And that population growth will be solely sustained by net immigration. I think we can all agree that as we move forward, we want immigration to continue, right? Legal, amazing immigration that made America what it is. We are an immigration country. It makes us who we are. We come from other places to better our lives in this free country, and it's a beautiful thing. So this is also very important because another way that GDP is sort of defined is population growth and plus productivity growth, right? So if we're not growing the population, we better get really productive. The good news is we've got much more productive. Technology makes us more productive. Guess what else should make us more productive? At least the studies say we should, is artificial intelligence. So as population growth dwindles, AI becomes more important. Technology becomes more important to make us more productive, so that we just don't have a sort of a deflationary or a slow growth GDP spiral, if you will, right? So that's why everybody's so excited about AI. That's why, there's wars probably going to be fought, whether probably cold wars and economic wars fought over who controls the AI and the positive benefits around that and who's the leader of it. Just 2 weeks ago, obviously, you saw some shots across the bow from a Chinese company that came out and said that they had matched America's AI engines in quality, or at least close to it, for a fraction of the cost. This obviously had some really far-seeking immediate implications. Nobody really believes a lot of the data coming out, but if 50% of it's true, could be trouble for a lot of business models, including the darlings like NVIDIA and others that may or may not have to figure out how to cut cost going forward, and might change how much investment is going into this space over the next 10 years and so on and so forth. So really important what's going on there for a lot of different reasons. Trade, tariffs, this is Apollo's information right here. They found that if Trump kind of did the highest end of what they could expect him to do, which is 60% on China and 20% on everyone else, would have roughly an 18% to overall tariff, which we obviously haven't seen in about 100 years. It's just uncharted waters for us in the modern age. And most people's estimates are that would have both a drag on growth, but also an inflationary effect. And the rhetoric has come down a little bit. They've obviously, Mexico and Canada have delayed theirs, or we've delayed theirs for about 30 days. Remember, Mexico's now our largest trade partner. It's no longer China. So China and Mexico and Canada are big deals for us. But it's still mathematically calculable. It's not the end of the world. Most studies are showing that the tariffs we expect should have about a 0.5% drag on GDP growth. Taxes. Tax expectations from the Tax Foundation based on what the Republicans were saying back in October of 2024. We don't know what they're ultimately going to implement, but they think that the most benefit is going to go to the higher income brackets, with the lowest benefits to the lower. Net positive for net tax change, but most of it to the higher income brackets. And if you combine the two together, this is Goldman Sachs's chart. They think in 2025 we have a drag from tariffs, a boost from taxes in 2026, and basically a net zero cause over the full cycle there. So that's some of the administration stuff. Obviously, it's really important. I like to tell everybody there's a difference between what's said on the campaign trail, what is tried to be implemented at the beginning of the presidency and the administration, and then what's actually implemented, right? The implementation process is very hard. You can't executive order everything into existence. This has obviously been a flurry of executive orders. They're pushing boundaries. Oh, by the way, Biden pushed boundaries as well. And, ultimately you hope the right channels, like Supreme Court, come back and say if something's illegal or not. One good example of that was Biden with student loan debt forgiveness. This seems like the new cycle, like it's going to happen every presidential cycle. We're going to have a lot of executive flurry orders backing out the old administration's orders, implementing their new. You wait around for a couple of years, see what sticks legally. So it's just a process. It always has been, always will be. That's why we have checks and balances. But obviously, some of the things that have been executed from an executive order standpoint will end up sticking. So let's jump into some themes. It'd be crazy to be here in 2025 in the world of AI and crypto and not talk about them. Ultimately, it's not something we directly invest in. But I at least want to address the topics because especially artificial intelligence is changing our everyday world. That's not a new concept. Artificial intelligence, the idea of it's been around since science fiction novels from the 50s, right? Probably before that. But definitely ever since computers came around, as people toyed with it, started to do more and more autonomous type instructions to help us do things, to help replace us. It's just accelerated really, really quickly to where we are getting closer and closer to where these things can work by themselves, can teach themselves, can talk to each other, both incredibly powerful and good and possibly dangerous. So it's something that I think at some point will be regulated. Let's keep an eye out for that. I mean, they definitely need to figure out what the limits are to letting these things run. But, just for this presentation alone, every day using emails, a lot of times just running questions by it. Love interacting with things like Chat GPT, just to get some ideas, just to help streamline and correct. And, you can plug anything into it and it'll help you try to make it better. So it's going to be with us the rest of our lives. It should be a net growth. In fact, if you look at this data right here from Goldman Sachs, their baseline is that it's going to add 1.5% or so to productivity. And again, if we're going to lose labor, we need to replace it with productivity. And their guess is it's going to replace about 1.5% worth. That's pretty amazing. On the high end, they think 3%. On the low end, somewhere in the 0.5% range. So pretty amazing help there. And a lot of people say, well, how are you going to replace the people that are fired because of it, right? It's going to replace jobs. How do you replace that? Well, we got to remember that technological advance is not something new. Look at the industrial revolution. Look at all the different things that we've come through. A lot of people were very, very excited when we were able to remove seeds from cotton using a machine, right? And a lot of people, weren't doing that anymore. Now, we have a lot of jobs that have been replaced by computers and other things. But look at this. Back in 1940, these are the occupations that did exist, that still exist today. More than half of the jobs that exist today didn't exist back then. We find ways to work. We find ways to help other humans in an efficient way. And once one task gets taken, we go find another one. So I'm not too worried about replacement. Again, over time, if we're going to lose because of demographics and productivity takes over, I think all these things work out over time. But it's definitely something that is progressing very rapidly. And I think that's where some of the fear comes from. This is the investment thesis, right? The investment in AI exposed sectors. And the expectation for growth of revenue in those areas is really, really big. So you can imagine when there is a pot of money, billions of dollars, hundreds of billions of dollars that are going to be in a space, people get really excited about it. That's not going to be limited to the NVIDIAs of the world or the computer companies. These things eat up a lot of energy, and we're going to need infrastructure and utilities and all sorts of stuff that are sort of after effects and pre-effects of getting into this technology. So those are some of the interesting things we'll see. Crypto, not something I'm going to touch on too long. It's more of a speculation to us, not an investment. So it's not something we really touch on with our clients' money. But I will, at least put this excerpt in here from Goldman Sachs back in 2018. It's like a million years ago in crypto world. But they are basically talking about what Bitcoin as a thing is, as peer-to-peer network that allows for proof and transfer of ownership without the need for a trusted third party. There's a lot of disagreement back then, even exactly what it is, diverging views, right? Where does it leave them? Their conclusion was that it can't work as a currency. I don't see that either. It's very hard to use. It fluctuates 10% in a day because Trump talked about tariffs. It's difficult to see it being used in that sense in a real capacity. But some sense that ledger-based technology that underlies it could hold promise, of course, right? I don't think people are owning it today because of any use cases, quite frankly. I think they're owning it because of speculation and number goes up. And anytime that's happened in the past, been a poor reason to own something. But guess what? It's important. And why is it important? Because the total crypto market cap is over $3 trillion, $3.25 trillion. That's not something that comes overnight or goes away overnight without there being huge ramifications. If you take $3 trillion, even of paper money, out of this economy, there's going to be huge ramifications. A lot of people have way too much money in it. A lot of people are levered to it. And anytime you introduce concentration risk and leverage to an economy in a $3 trillion asset, there can be widespread implications. So it's definitely important, but it's not something we're speculating on at this time. Energy, touched on it earlier. Both crypto and AI eat up an immense amount of energy in an amount that isn't even available today. So there's going to be a lot of investment in infrastructure, building data centers, figuring out how to power these things. There's been a lot of talk of small capacity nuclear, which I think are all great things for the future, no matter what we use them for. We're going to need more and more energy. It's the lifeblood of our global economy, but definitely the US economy. So that's definitely an area we'll continue to look at as well. Now, let's get into the markets. Let's get into valuations. Let's get into asset classes, because then we can talk about kind of what we're seeing, why we're balancing portfolios, how we build things, and then, what do we do with all this information? Well, if we look at the S&P 500, and remember, S&P 500 is just basically the 500 largest liquid public companies in America, right? And then they are weighted with the largest companies having the largest weight in them. And we'll talk about how much of a concentration they've gotten, but you can see the valuation at least. We're at one of the highest levels in the last 30 years, really one of the 4 highest levels that we've been in the last 100 years or so. And that's across different valuation metrics. In fact, I just say, is this high or is this low? In fact, it's more than one standard deviation outside of the average. So what does that mean? Why does valuations matter? Well, first of all, a lot of studies suggest that valuations are close to all that matters in the long run for your investment returns. But the way I like to think about it is the same reason that if you're at the ski resort during ski season and you hear the cannons in the morning and they're trying to shoot shells at the top of the mountain to create avalanches, right? They're trying to create mini avalanches so there's not a big one. Why do they do that? Well, if you leave one untended, then there's going to be multiple layers of different storm events, right? They don't melt, at least not completely in between storms. And so they build up like layers of a cake. And the more and more they build up and the more and more unstable, if you had a cake that was like 30 layers high, right? It becomes a lot more unstable. And the more and more layers you build onto that, the more unstable it gets, the more dangerous it gets because it has more mass, right? And if there was a trigger to that, it would be catastrophic. So I think of valuations as the higher valuation you get, the more and more layers of that snow you get, the more unstable it gets, and the more potential for very swift destruction can happen. And so a lot of times we just choose to go ski on another mountain that might have better conditions. That doesn't mean you can't get away with it. That doesn't mean that you are not allowed to do it. It's a free country, but we tend to want to go to the slopes that maybe have the less risk of death to them. Next chart here shows a Bank of America study that shows that they believe the S&P 500 trades about 40% rich to the long-term average and suggests about a 0 to 1% return over the next 10 years. Obviously not great. I encourage people to look other places other than just the S&P 500. I think a lot of people would suggest diversification, even something as simple as equally weighting the S&P 500, which there's also ETFs and funds that do that, or really any way you can diversify away from some of the most overvalued companies. And you can see here, this is what's happened. The top 7 companies in the S&P 500 now account for almost 35% of that index. And you can see if that's normal or not. Over time, that's very, very high versus normality, even in the 2000 area, when it got up to, looks like about 22%, and we're at 34% or so. Very, very high. And the expectations for growth from those companies is very, very high. So anytime the expectations are high and the valuations are high, any little misstep, any miss on earnings, any miss on revenue, you could have big tumble down, because there's just air beneath it, right? Think of the avalanche. It's a very, very unstable environment. Do you have to be that exposed? No, look at this. This is inside of the S&P 500. And this is how the average stock in the index trades versus the whole. So it trades at a very big discount, below one standard deviation discount to the whole. Think of it like kids in a classroom. Say you had 30 kids in a classroom. And the teacher decided at the beginning of the semester that he was just going to give everybody the average grade at the end. Well, you'd certainly hope that 4 or 5 people drug your average up. That's what happened here. These 7 companies drag the average valuation up because they are so high and they make up such a large portion. So there's ways to skin this cat that don't expose you to the same types of things. There's also just other markets. You've got mid caps that remain historically at a discount, small caps historically at a discount to the large caps. We're talking thousands of stocks. There's a big pond to choose from. You just don't have to choose that one if you don't want to. Or you can just own multiple things. You can own the S&P 500 and the NASDAQ. I wouldn't own both because we saw that they're basically the same thing right now. But you can own other things on top of that to where you have a diversified portfolio. I promise it works over time. We'll see a chart here that shows it in a second. Next thing I want to look at real quick, don't want to get too far into this, but this is interest rates. People have been so scared of bonds for so long. This is 2024 and the shift in interest rates. It was a big change from one type of environment to another. You see this purple line up here. This is very, very short term. This is a 1-month treasury rate. Down here, this is 5-year treasury rate, and this is the 30-year right here. So the longer ones were lower, the shorter ones were higher. That's called an inverted yield curve. That's typically not indicative of a healthy environment. But what happened here in September? You've got the short-term interest rates going down because the Fed was lowering their interest rate, and you have the longer-term interest rates that have made their way up to the top. Pretty extraordinary, to be honest. It doesn't happen too often that the Fed lowers interest rates and the long end of the curve goes up. Obviously, several reasons that can happen. One of those is probably inflationary expectations. They think by lowering short-term interest rates, it'll drum up more economic growth, which might add to the inflationary problem. It also might cause some people to worry about how the government's going to fund itself, and therefore we might need to get paid more on the long end. So that's what's happening in interest rates. We're back to a positive yield curve. And before you get real excited about that, because we're in a more normal environment, just remember most recessions have happened after the inverted yield curve as the yield curve is going positive again. I'll skip this slide. This one's just talking to correlations. Basically, bonds and stocks were highly correlated in the 2022 market because interest rates were interest rates going up from basically 2% to 5% had a negative effect on all asset classes, always does on bonds, but in this particular environment, it had a huge effect on stocks as well. This is saying that corporate bonds are at their cheapest in a long, long time versus stocks, only in a metric of earnings yield versus yield. And then this chart is very important to me. Don't be scared of bonds, please. They are what they are. They're very math driven. They're very easy to predict. In fact, if you bought a 5-year US Treasury today, this chart is showing what happens with a 1% fall in interest rate versus a 1% rise in interest rate. So obviously, returns go lower when interest rates go up. They go higher when interest rates go down. So take a 5-year US Treasury. If nothing happens, you get 4.3%. If interest rates go up 1%, you lose 0.1 of 1%, right? 1/10%. But if they go down 1%, then you make 9%. Right? The returns are skewed to the upside with bonds. And they've historically, not always, obviously, never say never, they've historically been a great hedge to stocks because usually in a recession-driven stock market fall, long-term interest rates go down, the prices of those bonds go up, and you make money on your bonds while you lose money on your stocks, and it helps hedge the volatility. And then you can go sell some of those and buy some stocks at lower prices. And it's a beautiful system to manage money. But you can see here, not much risk on the downside for rates. I mean, the most obviously you could lose if interest rates go up 1% is in a 30-year Treasury. You'd lose 11%. But again, you would only own a little bit of those for a hedge that would make you 21% if interest rates went down 1%. So let's put all this together. Let's look at what Wall Street expects from these asset classes. Let's look at what a balanced portfolio is supposed to be paying us. We'll look at Steadmont's expectations, and then we'll talk about what we do about it. So we look at Wall Street, their capital market assumptions. All this is a fancy word of saying what these firms expect these asset classes to perform over the next time period, which are defined here. So we're going to look at this middle section about 10-year returns. And you can see the average Wall Street firm is expecting US stocks, which is the S&P 500, to return about 5.7%, with the low end Vanguard being 3.7, BNY Mellon at 7.5. All of these are lower than the average returns over time of 9 to 10%. Okay, so people are expecting lower returns in a highly varying method, right? International is about 7.5, emerging about 8, fixed income about 4.5. This is where I get to, right? Fixed income is so predictable. What's a 10-year Treasury paying right now? About 4.5, and people are expecting bonds to pay 4.5 over 10 years. Well, that's exactly right. That's what would happen if you held a 10-year bond for 10 years, you make 4.5%. So it's more predictable, easier to understand what's going to happen, and much more safe in any aspect. Then if you blend those together in a conservative manner or an aggressive manner at 25% stock or 75% stock, we expect balanced portfolio returns over the next 10 years to average between 5 and 6%. It's not going to be 5 and 6% every year. You're going to have up 15, down 10, up 10, -5, up 5, up 8. You're going to have all over the place. It's going to average out to that over time. That's what fluctuating assets do. But it's a good place to start with our expectations going forward. We also run our own expectations. You don't have to look at these at all. It's just something I look at when I'm building portfolios and trying to look at why these firms are saying what they're saying. But you can see here, even in our own estimates, lower returns in the market cap weighted large cap in America. Doesn't matter growth or value at this point. We still see, we say overvaluation in both. See much better returns in the mid cap. The winner here would be small cap value. Been very out of favor for a long, long time. Not guaranteed results. These are just expected. We have a range of low to high. And then we have our expectations for bonds here. So it's a good way to just build our portfolios, be able to dial up and dial down the allocations inside of the portfolios because we're always going to be balanced and diversified. So what do? We plan and we stick to our principles. And what are our investment principles? Quality, diversification, time, price matters, and a new one, rebalance. That's right. I made a new one, but I have to put it there because people need to realize that we need to be doing actively things in the portfolio, even if they're not major changes. When markets move, we need to rebalance, and we'll show you how that can get out of whack over time. But let's walk through each of these just for a refresher. I'll be real quick. Quality, basic due diligence. We look at the people, we look at the process, we look at the performance, we look at the price or the cost and the type of product it is and make sure that it fits the portfolio for your needs and your goals. Diversification, this is great, right? You can see that the blended portfolio of all these asset classes is always sort of in the middle. Over time, you get a great return at a lower volatility. That's the way to do it. That's why we believe in that. It creates a smoother ride. We're trying to protect downside. We're trying to keep you on the ride. There's plenty of people out there that can't handle 100% stock portfolio. You can't handle when your livelihood, when your life savings down 50%. Perfect. You don't need a 100% stock portfolio. That is the risk you're taking in that. So if you blend these other assets, you're obviously seeing that you're going to have some downside, some upside, but mainly you're getting most of the upside and limiting the downside. That's diversification. There's also other things you can do. For instance, we have gold and commodities in our portfolios. Gold's been a great winner for the last year or so, and commodities should help hedge out some inflation. So it's a good thing to maybe have some money in. You got to, balance it a little bit. Market link notes, something we're going to be talking to our clients on an individual basis this year. It's just a type of investment. It's technically a loan to a bank instead of a traditional income payment. You basically get an options package that hopefully gives you some market-like returns on the upside with some downside protection. So we're interested in that type of arrangement. And then for people that qualify, private investments, why bring up private investments? Well, over time, they tend to benefit the portfolio from some higher upside. They obviously have a lot of volatility, but the ultimate reason why we want to is the majority of companies in America and worldwide are actually private, right? They're not in the public market. 75%, even of large companies in America are private. The company that we custody most of our assets with, Fidelity, is a private company. So this is a market that is untapped for all of our clients. And we want to, for the people that qualify for them, be looking at those types of things in limited amounts because they are highly volatile. I have an example of a client that had some private investments that they took on 5 years ago or so and lost their entire investment, right? Those are the types of things you can get into. The ultimate experienced returns are wildly varying. And so it's something you want to limit in the portfolio and do extra due diligence on in the meantime. Time, short-term money needs to be in safe assets. I break it into short-term, medium-term, and long-term. And I'm glad JP Morgan finally made me a slide that made this look right. So short-term needs to be very safe. Medium-term can be a little bit more aggressive at equities and bonds. Long-term, more equities than bonds, but still a mix of both. Why? In the short run, the only thing that's going to guarantee your return over a year is going to be cash, right? Even bonds and things like that can give you a negative return over the year. So if you need money, you probably need it in cash. 5 years, you start to take less risk by owning the other asset classes. And once you get out to 20 years plus, equities have traditionally been the thing that have given you the most return, which protects you against all the risks you can possibly think of, like inflation, geopolitical problems, political issues, currency issues. That's the thing you want in the long run, but they should be in their buckets according to your personal timeline and horizon and goals. And you simply just fund your life out of the short term. refill it with medium term, long term fills up medium. It's a beautiful system that if you work it over time, really keeps you out of trouble, really keeps you on track, and is a great visual for your money over time. Price matters. Talked about it earlier. Bank of America put out great research that suggests that almost all of your returns over time are because of starting valuations. In the short run, almost zero. So when I talk about high valuations, I do not mean the stock market's going down tomorrow. Probably going up. Until something happens, there's nothing holding stocks back. People, find no other opportunity. There's no, what's it called? TINA, right? There is no alternative to stocks. I think that's gone away, right? When bonds are paying 4, 5, 6%, but still people think that. And there's definitely no tie to valuation in the short run, a whole lot over the long run. And we build portfolios for the long run. So you can see expected returns from Bank of America for the S&P 500, cap weighted at roughly 0, equally weighted at roughly 5. And there's other asset classes obviously out there that have different ones. Rebalance. I talked about it earlier. If you don't rebalance your portfolio, the risk dynamics change over time. So if we start with a 60% stock portfolio and we hold it for 5 years until now, you now have a 72% stock portfolio. Is that appropriate for you? I don't know. But that's something you should be aware of as time goes by, that if stocks outperform bonds, you're going to get over allocated to stocks. And should we be rebalancing back to the original allocation, or is something in your life changed and we need to change the allocation altogether? It really starts with planning, starts with goals, and then you build a portfolio from there. And that really wraps it up for the data. I do want to make some housekeeping notes. Anybody that's doing required minimum distributions, if you're making those out of your IRA, know that if you're also giving to charities, that you should be probably looking at making qualified charitable distributions directly out of your RMDs. It's a way to avoid taxes on those dollars altogether. Anybody that's looking to fund their retirement accounts this year, realize you have up until tax time. Meet with your CPA, talk about that. 2024 tax prep. If you're a client of ours, you're going to have a tax statement from both Merrill Lynch and Fidelity this year, as we were in transition last year, as we opened up Steadmont. This is the only year it's going to be like that, but realize that that's out there. If you had access to Merrill Lynch online, you should be able to still access that and retrieve those statements. And just know the Fidelity statements as well as the Merrill Lynch statements will probably come out between now and the end of February. So be on the lookout for those. We do want to be transparent with Steadmont, what we're looking to do. 2025 Steadmont goals are real clear. Communication. We want to have the highest level of communication we've ever had. And that includes both phone calls, in-person meetings, and a lot of new stuff that we've been doing, like emails and texting and webinars and seminars. We want to be in touch. Know that you're in touch with us. You can always text us, email us, call us, walk in the office. We're so excited to be in our new office. We hope you can join us sometime soon. Lifebook, we're going to get the physical form back. If you come in for a meeting, we've got all the content, but not necessarily the book, and it all looking pretty. Looking forward to getting that up and going. And then the client portal. We're going to be introducing that. This is separate from your Fidelity login. It'll actually be a link into our e-money planning software. So any planning we do, you'll be able to see right there on a real-time basis where you stand versus your goals. If there's a big market correction, you can log on and see how you're doing, right? Has anything changed? It's a great resource to see your net worth, to track your expenses, to store digital documents securely. Great little tool for us, and we'll be introducing that. And also, we're trying to grow. And that doesn't mean you need to go give referrals. What I really mean is we are going to be growing. So expect to see new faces. If you haven't heard her on the phone or seen her in person, Amy Lanier is new to join us as of November of last year. We're so excited to have her. She's a rock star. We're looking to add more employees this year, as we are so excited to be out from under a place that had hiring freezes for us. And then we're also going to be taking on new advisors as we hit our stride. We want to bring, the times they are a changing, and in our industry more than ever. And we just don't think those big firms are built to change as much as they need to. And so we think we're going to be an oasis for people. The entire RIA industry is an oasis for those type of advisors. So we're excited to grow. We just want to make you all aware of that. We look forward to the growth. We hope you do as well. We look forward to doing more of these. I thank you so much for spending the time. I know it's been a long time, but I appreciate you hearing it. Very, very important message. We're in very volatile and dangerous times, and you just need to make sure you're aware that the tide's rising around you. Do you need to be swimming somewhere? Do you need to be making changes? That's what we're here for. If you're worried, call us. Let us help you, diagnose what's going on in your life, your financial life, and we can help you make changes. So we're here for you, and we hope that you do well. Here are our disclosures. Hopefully, Mimi, I nailed that on the compliance side, and we really appreciate your attendance, and God bless. Thank you so much.